Alrighty. So welcome everybody today. Minute after 3 if you're on the East Coast, and just moment after noon if you're joining us from the West Coast here. So I want to thank everybody for joining in for today's TMC Connect web broadcast entitled Freddie Mac Mortgage Cycle Time Benchmark Study. And want to remind everybody joining in, this will actually be the first of a three-part series with Freddie Mac that we're going to be hosting over the course of the next 6 weeks. So mark your calendars. There'll be more information coming around parts 2 and parts 3. The second piece being Freddie Mac's market insight studies for Q1 of 2021. And that's going to be coming on April the 14th, Wednesday. As well as part 3, where we take a deep dive into kind of deconstructing the millennial generation and have that lined up for Wednesday, May the 12th. So stay tuned for additional registration details coming up for both events. Before we jump in today, a quick shameless plug, and just kind of want to quickly walk through the ground rules for the discussion. As this is hosted from TMC Connect, encourage our attendees keep checking in on the TMC Connect and member event calendars on the Mortgage Collaborative website. It's a updated, constantly schedule of our upcoming TMC Connect web broadcasts. And feel free to submit to our team any ideas for sessions that you'd like to see in the future based off of current events or scenarios that are really vital to your world. Lastly, I'm excited to announce we're coming back live in person with the Mortgage Collaborative. So our summer conference and registration is actually open. You can find that on TMC's website as well. And we'll be coming back September 18th through the 21st at Terranea Resort in Palos Verdes, just outside of LA. So a beautiful coastal location, and going to be excited to welcome everybody back together in person from the network after what will be 18 months of being apart. So stay tuned. We're going to have a lot more details coming around for the event, but we can't wait to see you all this September. Well, in the meantime, with today's discussion, whether you've dialed in or you're connected via your computer, all lines have been muted for the call. That's not only to avoid any background noise in your area, just ensure that our attendees can hear today's presentation clearly. That said, we do want the discussions to be as interactive as possible, so highly encourage our attendees. Any questions that you have, feel free to submit those throughout, and that can be done either through the Q&A box or the chat function on the bottom menu of your browser screen via Zoom. And I'll see those questions coming in, and I'll be able to verbalize those on your behalf with today's discussion leaders. Last reminder, today's call is recorded. It will be available for playback. All attendees and registrants for today's session will receive a follow-up email tomorrow that will provide not only a copy of the presentation deck that you'll see today, but as well as access to check out the on-demand recordings, both via TMC Connect podcast, as well as the Mortgage Collaborative's YouTube channel. So on that note, let's go ahead and dive into today's discussion. As I mentioned, our friends from Freddie Mac are here to lead today and impart their insights from their findings of their mortgage closing cycle time benchmark study. And with us leading today's discussion, first off, we have KT Thomas, Senior Director of Market Research and Marketing Analytics. How you doing, KT?
Very good. Thanks, Tom.
Thank you so much for joining us. And from Freddie Mac, we also have Yana Davidovich, who is Director of Market Research and Insights. Great to see you, Yana. How are you?
Hey, Tom. Thanks for having us.
Pleasure as always. So I won't waste any more time on that note. I want to go ahead and dive directly in. And I guess, KT, I'll turn it over to you to kind of kick things off from here.
Wonderful. Thank you very much, Tom, and good afternoon, everyone. And I cannot, hold my excitement, when you just mentioned earlier that we're going to be all getting back together. Just that thought seemed like a total distance, but at least we can at least comfortably say that today. And that's actually got me really excited. So, looking forward for that, that will be coming up later this year. But anyway, I also want to thank you, Tom, for inviting us here today to share one of our most recent research studies that was done on mortgage closing cycle time. And before, I'll let Yana go into the nitty-gritty details, I do want to say that, why did we do the study? I want to share a little bit of background on that. One of the things that we always heard from our clients very often through surveys and discussions is the fact that all the lenders and our clients are looking for ways to be able to be more efficient and also create an environment where they're able to be able to complete a mortgage in a much faster and efficient manner. Of course, cost being the paramount factor here. So as we heard more and more of those requests and their needs, we said, it's time. It's time for us to do a study to be able to help our lenders, help our clients to be able to run a more efficient shop. So this, I would say, is actually a first installment in many other research studies that we'll be conducting, and there's another one actually already on the way around the cost. What does it cost to produce a loan, which is also under that same concept of how can we help our lenders and clients be able to be more efficient in the mortgage process. We felt this paper primarily was going to identify, number one, establish a benchmark in the industry as to what it takes, what's the average cycle time to close a loan. But then more importantly, also identifying what are the leaders and the laggards doing differently that is resulting in them being, either one end or the other end of the spectrum. And we actually were able to really dissect a lot of data to be able to get us more information as to what the leaders and laggards were doing. So again, I would say that this is the first of many studies. In fact, this particular study itself this benchmark study itself is going to be done annually. So as you'll see, as part of some of the data, cycle time doesn't remain relatively stable. It actually does have a trend, and the trends are caused by different, specific reasons. And so hence, we felt it was important to do this on an annual basis. With that said, again, I want to thank Tom for letting us be here, and I'll hand it over to Yana, who's going to go through some of the specific details within the study. Take it away, Yana.
Thanks, KT. Would you mind moving the slide? Yeah. Okay. Great. As KT mentioned, the big picture view, having as much data as Freddie Mac has at their fingertips, having the plethora and the brain trust, that is acknowledged by the industry, we did decided to take a shot and, perform a mortgage cycle time study. And that study, essentially, the idea behind that was to help lenders to create greater transparency across industry, enable performance benchmarking, uncover efficiencies for high performance lending, as well as develop a blueprint for future changes. As KT mentioned, an efficient mortgage process is crucial as it impacts cost and customer satisfaction, as well as competitive strengths. Moving on to the next slide. Thanks. Before we go into specific details, let's quickly go over some of the key findings that this study uncovered. First, cycle time has been on a declining trajectory in the recent years as more lenders adopt technology. But despite the long-term decline in cycle times, in 2020, last year, the industry saw an increase in production times as high refinance volume and COVID-related activity delays drove the cycle times upward. Yet another interesting finding that the study revealed is that the top performers, those are more likely to have implemented automated offerings and effective digital technology, close loans on average 63% faster than bottom performers. Last but not least, our finding reveal the cycle time of the top performers is consistent despite lender institution type or size. Moving on to the next slide. Thanks. Now, let's take a look at some of the detailed findings. Let's start with long-term trends. The industry average closing cycle times have been decreasing over the past several years as more and more housing industry participants adopt technology into their lending process. Technological advancement became a priority across the industry as more lenders implemented digital platforms and tools that drive cost savings, increase customer satisfaction, and reduce closing cycle times. As you can see on this chart in front of you, the average closing cycle time has gone from 46 days in 2016 to just 40 days in 2019. Furthermore, not only have average closing cycle time been on a downward trajectory, but it also has been converging across the whole spectrum of lenders. What does that mean? It means the range between the companies with longer cycle times and shorter cycle times has narrowed over the past several years. And interestingly, the lenders with longer cycle times have their processing times improved the most. It is a firm belief that as more lenders accelerate their pursuit of the end-to-end digital mortgage process, further reduction in mortgage cycle times will definitely be inevitable. Moving on to next slide.
Hey, Yana, I had a quick question come
Sure.
in for you here from one of our attendees. Curious to understand who all participated in these benchmark studies.
It's
I'll
an
let you go ahead.
excellent question. No, excellent question. And that's something that we should have started with too. So essentially the study was designed to take every single lender that does business with Freddie Mac, which is about 45% of all the active lenders, all the volume that is hitting the industry or from a conventional conforming perspective. So we've calculated that the sample size was over 1,000 lenders. So quite a big sample size. And we will talk a little bit more about the size of the lenders that were part of the study in more details a little bit later. Great. Any more questions, Tom?
All set for now. Thank you.
No worries. Okay, moving on. So despite the long-term improvements that we just showed on a prior page, in the short term, the industry experiencing an increase in cycle times. And I'm sure you're all aware of it. In the second quarter of 2020, when the study was done, the average closing cycle time was 44 days, a 10% increase compared to a year from a prior year, second quarter of 2019. On the refi side, the year-over-year change was even more pronounced, was an increase of 5 days in production times, or 13% ramp up. The lower ramp up was seen for the purchase-only loans from 40 days to 42 days. Furthermore, our recent analysis showed that the ramp up in cycle time had continued into 2021, as you would imagine. We'll talk a little bit more about the reasons after, but it actually had increased to 52 days in first quarter of 2021. So quite a jump. Moving on to next page. Let's delve into the drivers of the cycle time ramp up. As all of you experience firsthand, the industry has faced significant changes last year. High volume caused by low interest rates, as well as enforced closures and social distancing driven by COVID-19 pandemic, have caused mortgage closing cycle times to increase. Through our research, we've learned that COVID-19 related delays added on average 2 to 2.3 days to a mortgage production cycle time. And the impact was primarily on purchase-only loans. Social distancing measures caused delay in processing activities related to mainly non-lending aspects of buying and selling homes, such as completing home inspections, scheduling movers, and remediating agreed upon inspection findings. As noted previously, increased mortgage refinance activity is yet another, and actually probably a bigger factor that we've seen driving the cycle times upward. The record low interest rates caused a ramp up in refinance activity, which is in turn caused backlogs, significant backlogs. This in turn resulted in extended closing cycle times, as I said. Our study found that the impact of production backlogs on the refi mortgage cycle times back in second quarter of 2020 was 4.6 days. But it did vary depending on the size of the institution. So for instance, the larger the institution, the smaller the institution size, the larger the delays that we've seen. And as I said, we'll talk a little bit more about that later on. As our Freddie Mac economic forecast calls for a decline in volume in 2020, we do anticipate that the average cycle time will eventually decline as the refinance volume wave subsides in this year, specifically later in this year. All right, moving on to benchmarks. To help institutions measure and compare the average cycle time with higher accuracy, this study delivers cycle time distribution by quartile, and not just overall distribution, but for both purchase only and refinance loan categories. According to our analysis, for the overall view, the top 25% of performers process loans on average 20 days faster than the bottom 25% of companies. This results in a savings of 63% in average processing time. It takes top performers on average 32 days to process a loan, where the bottom performers do that on average in 52 days. This effect is even larger for the refinance mortgages that the middle section, the right-hand side chart, where the gap between top and bottom performers is on average 23 days, with top performers closing loans 74% faster. As you can see in the chart above, certain top performers process loans as fast as 17 days on average, where certain bottom performers can go as high as 105 days. Our hope is that this measurement mechanism will help lenders across the ecosystem to benchmark themselves against the rest of the market participants. And hopefully, if you have any questions, to be able to answer. I could see there's one in the chat. If not, I can move on.
Yeah, I got a question here. Yana, just wondering, if there's any insights you could share, I guess, from a volume metric standpoint that Freddie Mac used to identify, I guess, who qualified as top performers versus the rest of their originating peers?
Excellent question. So when we were creating a study, a measuring mechanism, what we've determined is that we've given every single lender the same weight. So what that means is we would look at individual lenders and look at the total number of hours they spend and divided by the loans that they produce. What it means is there's really no weight that is assigned to the size of the lender. They all have an equal size. Hence, the reason why you're seeing the gray category being so high is because that represents about probably the big chunk of that gray section in these charts are small lenders. 60% of our lender base are small lenders, and that's what you see here is a weight that there's really no weight assigned to individual lenders based on their size. Make sense?
Makes sense. Thank you so much.
Mm-hmm. All right, let's move on to top performer discussion. So when we created the study, one of the main questions we wanted to answer is what is driving better cycle time efficiencies for the top 25% of performers? What sets the top performers apart? Through our research and expert discussion, we were able to identify 4 best practices that may help lenders and other mortgage professionals learn from how the top performing companies are leading. First, Kitty, I think you need to yep, thank you. So first, use of automated offerings. Today's housing ecosystem requires levels of speed, accuracy, and cost efficiency greater than what people power alone can provide. We all know that automating repetitive tasks in loan application process streamlines workflows and leads to greater speed and efficiency. AI technology can drastically cut manual labor times. Underwriting efficiency offering like asset and income model or AIM save time that company can spend on customer service and other tasks that only people can do effectively. We identify that automatic offerings produce an average between 9 to 10 days of savings in closing cycle times and could be as low as 5 days or as high as 15 days in savings. Second, the effective digital technology implementation. The traditional challenge for lenders attempting to create new technology is that systems used by all in the loan origination process have been dissimilar and not integrated. Lenders who leverage digital technology effectively are typically the ones who focus on integrating digital enhancement across all systems. These top performers set themselves apart by adopting easy-to-maneuver technology that is scalable and structured to incorporate external as well as internal digital platforms and tools. And to make the integration technologies thrive, it is extremely important to focus on training, such as offering information and support relevant to each jobs and functions. Otherwise, adoption could be a challenge. Third, creating effective digitization structure. Many lenders implement a digital infrastructure that leverages a mix of buy versus build when it comes to the technology they need. They look to build at least some proprietary internal capabilities, but are also quick to take advantages of their partner tools and platforms, such as e-mortgage capabilities, automated income asset assessment, and document and rule management. These leaders also adopt a test and learn approach, which is extremely important. Fourth on this list, not in any particular order, is customer focus. Customers today increasingly want faster and easier ways to maneuver through the mortgage process. Given the latest development concerning COVID-19, customers want a limited to no touch experience to provide a better buyer experience while maintaining an efficient production cycle. We need to, it is critical to be customer facing, to have customer facing tools. Top performers tend to adopt a robust digital experience that provides an omni-channel, consistent look and feel for better interactions. So by leveraging all these right tools, technology, and customer-focused approach, lending institution can certainly scale to manage demands when volumes go up or down, increase consistency of loan decisions, reduce errors and cost, and reduce time to close and drive better customer service. I see there's a question. If not, can move on. So having the right technology tools is extremely important, but so is having a big picture strategy and vision, as well as to implement a plan to effective adoption to create a properly integrated ecosystem. We find there are several characteristics that differentiate top performers in this space, and these are to have a consistent, well-maintained technology and business capability multi-year roadmap that your company can leverage to align with key partners. Factor the scalability of new capabilities into your decision-making when investing in new areas and initiatives. Roll out new capabilities in small pilots for better optimization, and assess business goals, user transformation requirements, risk, and organizational culture before choosing the most effective and appropriate adoption strategy for a new platform or system implementation. Moving on to next slide. All right, now let's take a look at a performance evaluation by lender category, which is probably going to be the most interesting to you guys. In this case, we are looking at the institution type. So what you see in front of you, before I'm going into details, I want to explain this chart a little bit. So what we've tried to do here is we've looked at the average cycle time of the bottom performers, top performance, and the average. And what you see on the left-hand side is the overall characteristics. So as you can see, the average cycle time for top performers is about 32 days, where the average, as you remember from prior slides, is 44 days. And the bottom performers average the cycle time around 52 days, if you remember. And what we've decided to do is sort of compare that to and see what the individual institution types are doing and how they are weathering compared to the overall structure. And this is what we found. So according to the study finding, among all institution types, independent mortgage banks, or what we call IMBs, process mortgages faster than depositories, meaning banks, thrifts, or credit unions. Take a look at the average cycle time of the IMBs at 39 days. IMB process mortgages 7 to 9 days faster than other lenders. This may be because of a number of factors. IMBs borrow money to lend versus banks that source their own funds. As a result, independent mortgage banks have more of an incentive to drive time down because they operate from a higher baseline. Independent mortgage banks are monolines, or institution with a single line of business with traditionally more cost-focused and effective structure. IMBs are pursuing digital enhancement at a faster pace in order to remain competitive and stay in business. Last but not least, many of the fintechs that we're all hearing about who are so successful in this environment are IMBs. So while independent mortgage banks lead the way in cycle time metrics across institution types, it is important to note that the top performers within other institution type have adopted digital advancement have managed to achieve significantly better cycle time between 30 and 32 days, as you could see in this gray section, dotted line section, than their peers. This suggests that no matter the lender institution type, the streamlining and digitization of the operation can drive efficiencies and lower loan process timing. Moving on to next slide. We've done the same thing with the institution size. So instead of looking at institution type, now we are comparing the overall view to the institution size. So we've looked at the large lenders, we've looked at the medium-sized lenders and small-sized lenders. The small-sized lenders, I believe we define as anyone who is delivering less than 250 million a year. And if you need additional detail on additional sizes, I can definitely provide that as well later on. Anyhow, so what we found that is the mounting mortgage volume continued to put pressure on lender production processes, and it is especially seen for the small size lender institution. You could see that their cycle times were more impacted by backlogs than any other size institution. In second quarter of 2020, on average, smaller size lenders processed loans 5 to 6 days slower than their larger counterparts. As small institutions represent more than 60% of all institutions measured in the study, as I've mentioned before, this ramp up in production times drove the overall cycle time upward. So there are several reasons for the deviation in closing cycle time between large, medium, and small lending institutions, such as the lack of economies of scale. When smaller lender volume of application triple quarter over quarter, the backlog added more than 2 extra days to their production cycle. Also, the lack of use or presence of technology. We found that smaller lenders are less likely to leverage the digital offerings of their partners when compared to their larger counterparts. Due to budget constraints, smaller institutions are less likely to make digital investments. As with the institution types, it is important to note that the cycle time of the top performers within smaller size institutions were comparable to higher performing organizations. This is because streamlining and digitization of operation often drive efficiencies and lowers loan processing times. This suggests that smaller lenders who have invested in this technology are able to achieve shorter processing times, like similar to mid and large size institutions. All right, moving on to next slide. That brings us to study takeaways and look forward. As we underlined through the study, it is important to understand ways to manage cycle times, which can help determine production effectiveness and ability to compete. The ongoing challenges presented by the COVID-19 pandemic and capacity constraint driven by higher refinance volume activity have placed significant pressure on lenders across the industry. To keep pace with the trends, many lending institutions have focused on technology investment to help them address their changing market and competitive needs of the mortgage origination process. What does the future hold for mortgage cycle times, you ask? I guess we'll find out in our next study, but with home purchase and refinance expected to remain fairly strong in 2021, having high quality, well-maintained technology plus leveraging partnership will be more imperative this year as competition will get stronger. Our hope is that this study and our future studies can potentially be utilized to benchmark your company's performance and help better understand key drivers behind shorter production cycles, which in turn drive lower cost, more effective performance, and better strategy decisions. That concludes our presentation. So if there are additional questions, I'll be happy to answer those.
Thank you so much. I thought that was extremely informative. And yeah, I would just want to remind attendees again, any questions, comments that you have for either Yana or KT from Freddie Mac's benchmark findings, particular to the closing cycle times, feel free to drop those in the Zoom chat or the Q&A functions, and I'll be able to provide those out on your behalf. Do have a couple questions here for you both. Yana, you mentioned specifically 250 million in delivered volume to Freddie Mac being that tier for the smaller lenders is classified in this study. Can you define out for us what the volume metrics were for the medium and large size lenders from the findings?
Absolutely. So large institutions, lenders in Freddie Mac database whose total volume, not Freddie Mac deliveries, but total volume is about 1 billion. Mid-sized institutions are between 1 billion and 250 million, and the small would be 250 million and lower.
Perfect. Appreciate that clarification.
No,
Thank you.
no problem.
And then another question I had, if there were any stats or maybe plans in the future for statistics to compare closings and the cycle time on them for wet sign closes versus either hybrid or fully e-close executions.
That's a great question. We are thinking about this. So right now we're sort of gathering some thoughts about what would be most interesting for the market to understand about benchmark study, right? We've sort of delved into the top performance characteristics and other use, but we hope to do more and uncover more insight. So we definitely will take this into consideration, and we'll try to include this in our second study that we hope to release at the beginning of fourth quarter, maybe October, November timeframe.
Excellent. And I think it makes sense to, obviously, as there's more adoption on the hybrid and fully e-close capabilities, that there's more of a sample size to be able to leverage for those benchmarking statistics.
Absolutely. And just, Tom, I wanted to add one more thing. I think our goal is also to sort of dissect the process itself and understand where most deficiencies could be captured throughout the process of closing, not just the total number of days, but sort of look at the the underwriting process, the approval, and other components of the cycle time, which I think a lot of people would appreciate, or a lot of customers will find valuable.
Absolutely.
Yeah, that was a good question, actually, because that's exactly where we want to go. Because we kind of just hit the first surface, but if you dig this down a couple more levels, is where you even be able to find the specific nuances that even drive additional cycle time savings.
Yeah, I could agree more. I think and you guys both kind of laid it out in the deck involved that those leveraging more a fully digitalized process and the technology enhancements available, clearly seeing some benefit as far as those closed cycle times look like over the course of the year.
True.
Got another question here for you both. From one of our participants, I understand the data came directly from Freddie itself, but where does Freddie get the data for application date, closing date, etc.? And then the second part to that real quick is that in the information that lenders provide in the upload files direct to Freddie Mac?
That is accurate. So we've actually leveraged multiple systems to create that calculation. So one is an application database where lenders provide that information, and the close date. I mean, there's also lenders provide that as well. Yes, just through different channels, but yes, both the data points are provided to us.
And I've got another question here, and it's last call for our attendees to any additional questions that you have. Feel free to drop them in the chat or Q&A functions. I'll verbalize them for you. Another question I had here, in talking about digitalization positively impacting the lender cycle times, in the findings, did you see any common components, I guess from a technology standpoint, that digitalization that you referenced included? I guess, for example, like those leveraging RON technology or conducting hybrid or e-closings, if that was able to be kind of deciphered in those findings.
I think there were a combination of things, right? So when we've collected these insights, there were more roundtables across the SME subject matter experts. We were able to sort of capture that information not just through the data, but also through verbatims that the individual institution gave us. Unfortunately, sometimes we are unable to see a consistent view across some of these digital components, but there are definitely, like when we see the end-to-end process, as you would imagine, it does create efficiencies. And I mean, one of the biggest one, I hate to use the plugin here, but a loan product advisor, our own systems, the efficiencies that we're seeing leveraging those digital tools is very telling. I mean, as I mentioned in the study, you could save between 5 to 15 days in cycle time just leveraging, LPA digital tools.
Yeah, as you're familiar, we have our ACE and AIM tools, and those tools definitely contributed to some of these time savings.
Yeah.
It's just shaving off, some of the traditional lags that you have when you use these tools. It's completely shaving those off.
And it only makes sense to leverage the tools that Freddie Mac's providing, especially in delivering volume back to Freddie Mac. It can only be helpful to your point, just to kind of shave days off the cycle time, which is so vital, to lenders right now, especially with the volume constraints out there. Had a quick general comment coming in, just thanking you both for sharing the great information today, and looking forward to our future discussions coming up in April and May.
Oh, thank you. We're very happy to be here.
Thanks for the opportunity to speak to you all. We appreciate it.
Yeah, absolutely. And taking a look, I don't have any additional questions at the queue at this point. So Jan and KT, I want to thank you both for the time today and really the valuable insights. And just a reminder to our attendees that we'll incorporate a copy of the deck that you saw displayed today as part of the follow-up correspondence, as well as those links to be able to access recording of today's discussion, either via audio for our podcast channel or be able to catch the video as well through the Mortgage Collaborative's YouTube channel.
Thank
So
you. And we
um,
look forward to coming back. I know we got a triple header, right? So we look
that's
forward to
right.
coming back very soon.
Yeah, we're just warming up the crowd today. Going to be a lot more insights coming over the next two sessions. So we'll have some promotional content out to the membership too, just to keep that top of mind for today's participants and our membership as a whole. So stay tuned for that information. And thank you so much for joining us today, and we'll see everybody soon.
Thank
Thank you.
you. You're welcome.